Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we are breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving into: the tariff uncertainty and how corporate leaders are making plans and navigating the current environment. We're speaking to one former CEO on that, plus NVIDIA CEO Jensen Huang's diplomacy between the U.S. and China. And getting a check on the health of the consumer and small business. Huntington Bank reporting earnings today. I'm speaking with that CEO straight ahead. And we're gearing up for a busy week for earnings with names like Tesla and Alphabet set to report. We've got the breakdown on what you need to know to get ahead. Well, businesses have erred on the side of caution as uncertainty reigns during President Trump's second term. But our next guest says a wait-and-see approach could be a risky move for companies. Former Medtronic CEO and Harvard University Executive Fellow Bill George joins us now to discuss. Bill, it is good to see you. I want to start, Bill, with some very well-known CEOs who have been making headlines. And I thought of you, Bill, because I would love your take on this. NVIDIA's CEO Jensen Huang, Bill. The way he goes and he meets with Trump and then convinces this administration to reverse course on his H20 chips, Bill, was impressive. I think it surprised some folks. And I'm just wondering, Bill, what it tells you, what it teaches you about Jensen Huang's capabilities as not just an executive, Bill, but what it tells you about his skills that he's developed here as a diplomat.
Well, I met Jensen about 7 years ago. He's a very impressive guy, and I never dreamed that things he was talking about would blossom the way they have. And he's got the hot hand, obviously the most valuable stock in America. But I think the significant thing is, yes, he's developed these skills to try to convince the president. He's got to open things up and let him market in China. Very wise. Unfortunately, or fortunately, we've come into an era of crony capitalism, where a few select, particularly tech CEOs, have special access to the president, and everyone else is on the outside wondering what's going to happen next. And I think it's causing a lot of CEOs, Josh, to hold back. So yes, people like Sam Altman have access, and Elon Musk did, and Tim Cook did until he got bashed a bit for going to India. But I think you're seeing an era that's very different than we'd seen in the past. But
to that point, Bill, I guess my question was whether you think, after watching Jensen Huang, were there any lessons learned, Bill, in how he's dealt with Trump and dealt with this White House administration, lessons that other CEOs could learn from that?
Well, he was very persuasive and convincing, and then he had to let him market in China. And personally, I'd like to see more trade with China. So I'm very much in support of what he did. But look, not everyone as CEO is going to get that kind of access to the president or even his inner circle. So thinking that's going to save your company, for all the people listening here, I think is a big mistake.
What about the bank CEOs, Bill? Of course, those big banks, they're reporting earnings. I did think it was interesting how many of those bank CEOs, Bill, listen, they were weighing in on the Trump-Powell headlines, Trump's increasing political pressure on Powell. The way those bank CEOs were weighing in and saying, listen, reminding us that we expect to have an independent Fed, reminding us why an independent Fed is important. I mean, that of course would seem, Bill, to have been a message to Trump, maybe to Bessent as well. I'm curious whether you think that was the right approach by those CEOs.
Absolutely. And I think the banks are in a very sweet spot right now. You've seen some of the results coming out. Goldman Sachs had a fabulous quarter, particularly in its trading arm. Its investment banking was up too. And JP Morgan had a very solid quarter. I think the banks are in a very good position. Trump is pulling back somewhat on a few key esoteric regulations. And yes, no one wants to see the Fed lose its independence, I can tell you. Even if the president wants to jawbone Jerome Powell into lower interest rates, he's not going to do that. And I think it's all a bit of a game right now. But yeah, I think the bank CEOs are doing well, including organizations like Barclays and Societe Generale and others, European banks. So everyone's in a sweet spot right now with regard to banking. That's good because they're well capitalized and have strong cash flows. And I think they're seeing opportunities to invest for the future. My big concern, Josh, I think people are holding back from investing right now, waiting to see where the tariffs settle out. And I think that's a big mistake. I wrote to CEOs this week saying, Don't wait. Get out and invest now. Most of your investments are going to take 3, 4, 5 years to pay off, long before the tenure of this, beyond the tenure of this administration. And I think you need to invest now. A lot of them are saying, well, let's wait and see. And their lobbyists are telling, we can negotiate this all the way. Tariffs are not going away. We're already gone from 2.5% to 16.6%. And if the August 1st tariffs go through, we'll see over 20%. We haven't seen anything like that since Smoot-Hawley. And I think it is going to be inflationary. It is going to change the game. But I don't think CEOs can afford to hold on. They have deals to do. They should do them. If they have investments to make, they need to invest now. Even if there's a mini recession coming for the next couple of years, the investments will pay off. And they should move forward while everyone else is holding back.
So there is uncertainty around tariffs, Bill, but those CEOs, those CFOs you're talking to, the big beautiful bill is now law, so they know what those tax rates are. Does that clarity, does that give them more confidence to invest and spend?
We haven't seen that so far. They're talking a good game about investing in America. You don't see manufacturing heavily coming back to America, certainly not yet. And I don't think you're going to see it in the employment numbers. But I think the confidence that they're waiting for is on tariffs. And that's the big number for them. Look at the Chinese tariffs. They're huge. Okay, we cut back from 145 to 60. This is incredible. And it is causing people to rethink their supply sources. But mostly those who are in China are re-looking at other Asian sources rather than coming back here because they know they can't be competitive. Like Tim Cook on the iPhone. He knows he has to invest in India to get a balance with China. So, but I think they know the tax, but I don't think that was a big surprise. I think everyone assumed their tax rates would be basically what they were, not changed. There would be a lot of other goodies in a bill like that. But I think that's not holding it back. The tariffs are. And my message is get out there and invest now. Don't wait, because I think you're going to see those that go on offense, in spite of all the chaos, are going to be the winners.
Final question, Bill. You mentioned Tim Cook there, so I want to ask you. There was an analyst who raised the question, Bill, whether it was time for a new CEO at Apple. It was time for a change in the C-suite in Cupertino. That generated a whole lot of discussion, Bill. I'm curious to get your thoughts on it.
That's a cheap shot. Tim Cook is a fabulous CEO. He and Satya Nadella are right up at the top of any list of CEOs and how well they've managed through good times and bad. And Tim is making very wise decisions. He's realized it's not all going to come from the President of the United States. And I think he's doing a great job. Sure, he's faced some challenging times in China right now. He's taking action to correct that. And he's playing it for the long term. And I think you'll see Apple come out a very strong winner. They pretty much pushed Samsung aside in the iPhone race. And they're going to do a lot of other things. They'll do really well in AI. I know they're behind now, but they have tremendous talent. And they'll come back strong in that field. So it's easy for someone to say, push them aside. No, I don't think so.
Bill, always great to see you and to have you on the show. Thank you.
Thank you, Josh, for having me.
Shares of Huntington Bank fell on Friday despite the regional lender raising its annual interest income forecast as they expect to deliver record net interest income for the full year. Huntington Bank is one of the country's largest small business administration loan originators with $210 billion in assets. Steve Steinauer, Chairman, President, and Chief Executive Officer, joins me now to break down the latest earnings and expectations. Steve, it is good to see you. So you did report results, Steve, and the stock slipped a bit. I was talking to an analyst who covers you all, Steve, and he was saying, Steve posts solid growth, but he said the guidance he offered implies the next few quarters could maybe be slowing down a bit. And he said the question on the street for investors is whether Steve is being just kind of conservative here, or no, is he looking at the outlook? Is he talking to customers and has reason to believe that things may be a little bit slower in the quarters ahead? What's your answer, Steve?
Well, we had a spectacular second quarter, and with that, there was a certain amount of pullback. We had 8% year-over-year loan growth, but there was a pullback. There's some uncertainty about going forward. So on the margin, it affected some of our lending activity. It would have been even stronger. And at 8%, I think it's peer leading. So we've hedged it a little bit because of the ongoing uncertainties. We enter this quarter very strong. We've got great conviction in the third quarter. And typically, the fourth quarter is our best quarter of the year. So we're trying to call it with a bit of conservatism.
Given the uncertainty, Steve, you do have, though, very, interesting insight and line of sight into the U.S. economy. How would you generally, Steve, characterize the economy here? How healthy, how resilient does it look to you?
Look, I think the underlying economy still is relatively healthy. There's a lot of transition going on the manufacturing side that's tariff related, supply chain repositioning, substitution of parts into different production environments, things like that. So it's really difficult for manufacturers. And having said that, companies are doing reasonably well. Consumer is surprisingly strong. We see that with very low delinquency levels, and our losses were very, very low. Net charge-offs 20 basis points. In our peer group, that's probably one of the best numbers, if not the best. So we're still quite optimistic about the economy. We need to get a few more things settled down. We've got the tax code now set, so that's a big relief. And I'm optimistic as we get through the tariffs and some of the other issues that things will settle down. And again, this core economy is in relatively good shape.
You mentioned that big, beautiful bill, Steve. What's interesting is when I talk to economists on the show, Steve, and I'll ask them about that, I would say their enthusiasm broadly, it's sort of tempered in terms of what it will mean for the economy. But you're actually, you're running a business. What do you think it's going to mean?
Well, we're a very large equipment finance lender. We're number 4 or 5 in the country. So the accelerated depreciation is going to be a big boon for a CapEx for equipment, and that'll be very significant for us. So at a business level, we think this is going to be very helpful to us and frankly, on a longer term basis to our society, because all of the onshoring, reshoring, all of the expansion in the U.S., it's all going to get boosted by the accelerated depreciation provisions in that bill.
I want to talk about the Fed with you as well, Steve, because we've had some notable economists on the show this week. I'm thinking of one in particular who told me, listen, he does not think you're going to see the Fed cut this year. That is the base case he's telling his clients at this point. Certainly would not make the president happy, but I'm curious, Steve, let's say that's true. If the Fed doesn't cut this year, that means what for your bank?
Doesn't have any significant impact on us either way. We're hedged to neutrality. If they cut, we're modestly better off, but we've expanded the NIM significantly throughout our net interest margin significantly throughout the year anyway, and that NIM will hold, and it's in a very tight band now. So our asset growth will fuel net interest income growth, and we feel optimistic about it. We've had a great, as I said, great first half, and our second half is usually better.
Let's talk about an acquisition you made, Steve. That made some headlines. You're buying Veritex. Walk us through that decision and what it means for the bank.
But we've been investing in different businesses. We've been in the Carolinas investing. We have 8 new specialty banking areas. We're still investing in the core, and we're doing very, very well. We've been in Texas since 2009. Veritex is headquartered in Dallas. We have a little over $5.5 billion of loans in Texas today. We're the number 1 SBA lender in Texas. Veritex is in Dallas and Houston, which is exactly where we want to be. And the ability to combine with them, it's a great group of talented bankers. They have a terrific leader in Malcolm Holland. He's going to join us as well. And so this will let us bring the full franchise of Huntington to Texas. It's a big deal for us. We think this has a lot of upside. We talk about this as a springboard, and we think it will be. Texas is either the fastest growing state or very close to that, and it's huge scale, and it's exactly where we're positioned.
How do regulators feel about it, Steve?
We've obviously pre-cleared these things with regulators, and we're pre-cleared to go. We managed the company. We managed the company for 15 years with an aggregate moderate to low risk profile. A couple of years ago, when Silicon Valley Bank failed, we had the best liquidity profile of any bank our size or larger, and we've maintained that. And that has positioned us to make investments and grow the bank when others have been reluctant or have chosen to take a different course.
Steve, great to see you and to have you on the show. Thank you so much for your time today.
Thank you.
The NASDAQ hits a fresh record close as the S&P 500 posts a weekly gain. For more on the trading day takeaways, let's bring in Yahoo Finance's Jared Blickery. Jared.
Thank you, Josh. You said at NASDAQ record highs thanks to tech, and that is my number one takeaway. Tech at record highs, and let's just take a look at some recent price action. Let's go to the NASDAQ composite, and I will look at a 2-month candlestick chart. You know I love candlesticks, and you can see the trend has been up and away since about June 20th. So 3 weeks or so we've had this extension. Now contrast that with the S&P 500. It has just been treading water. It managed a new record close yesterday, managed a new record intraday high on the open today, but essentially kind of stuck in there. It's been really fascinating to watch what is working and what is not. So people have been talking about bad breadth, and that is the case that we haven't seen a lot of stocks climbing and participating, and that kind of speaks as to why the S&P 500 is stuck in a holding pattern. But then we've seen a lot of the smaller stocks and some former meme stocks really get kind of lift off here. And here's the sector action. Tech up 2% for the week, followed by utilities. That was interesting. But let me go over to our meme stock board. And we saw a lot of action in here. Remember Palantir? This is a large cap stock now, up 8%. Coinbase hitting record highs, Hood up 11%. But I want to hit Carvana. It was up 1.1% this week. Nothing to write home about. But here's the max chart. And this is what's catching my eye. This was a $350 stock in the meme stock craze of 2021, lost 99% of its value, closed at $3.55 in December of 2022. And guess what? After being down 99% to get back up to those record highs, it had to 100x. And that's what it has done. And so that is just kind of telling you what is going on. So there's a lot of money. It's just trying to find a home in the markets right now.
What's behind the strength in risk assets, Jared? Like tech and the meme stocks you're highlighting there?
The global liquidity spigot. So I was just taking a look after reading the blog of Michael Howell today. He talks about liquidity and central bank spigots, and that is what we are seeing right now. China started really printing last year in September. That is catching up. What we're looking at here in green is the S&P 500. This goes back to 2003, 2004. Could be log scale, but we'll stick with this. And then we have global M2 money supply year over year, and this is a percentage. And you can see in the white here, it goes up, it goes down. But what we're seeing right now, after this big pandemic up and then down, crashing into negative territory, it is now peaked above this high that we saw earlier last year, and now we are at the highest level since 2022 or 2021, and on the way up, basically the highest level on the way up since 2020. And so that is why I think we're seeing a lot of this kind of strange price action. You throw in a weak dollar and you got the floodgates.
It's Friday.
Yeah.
We know Bitcoin doesn't sleep. So what are you seeing in crypto?
Crypto week wrap. And let's take a look at this because we saw a lot of action, not necessarily in Bitcoin. Let's take a look, and we'll do 5 days since Monday. See Bitcoin down 2%, but Ethereum really took off, up 16%. Let's take a quick look at that chart. We'll do a 6 years so we can see pre-pandemic and how it's just been kind of, it looks like it's ready to break out of a trading range right here. It hasn't happened just yet, but if it breaks free, that just gives it a lot more momentum. And then if it does, I'd be surprised if it doesn't take that out, at least test it. And then here's another one, Ripple. Ripple has been testing all-time highs. It's exceeded some of these highs depending on which exchange you're looking on. But look at that. This is right up against the highs that we saw in 2018. Ripple was kind of left for dead in 2020 after the SEC was going after it, but it is back to life. And I just want to show you the equal weight version of what's happened this week. Lots of action there, not a lot of downside action. And I've been talking about the breadth in crypto. Well, there you have it.
What's on the radar next week?
I got earnings. I'm watching commodities, especially platinum, palladium, doing a hit on that Monday morning. And also the dollar. Is it going to go up? Is it going to go down? Going to go down? We'll have to see.
We shall see. Thank you, Jared. Appreciate it. Stick around. Much more Ask for a Trend still to come. Time now for what to watch in earnings. It's a big batch of earnings coming up, including Coca-Cola, General Motors, Alphabet, and Tesla. Starting off on Coca-Cola, Coke reporting results for the second quarter on Tuesday. This is coming after a Truth Social post from President Trump saying that he had talks with the company about using real sugar cane in its products, a claim that Coca-Cola did not confirm. Shifting gears to General Motors, GM is posting second quarter numbers on Tuesday. Analysts expecting the company to report earnings in line with analyst estimates, but like most players in the EV space, tax credit changes could cause issues ahead for the automaker. And And moving over to Alphabet, the Google parent company reporting Q2 earnings on Wednesday. Investors keeping a close eye, of course, on AI investments that may push up the company's capital expenditures. Ad prices and the cloud business also in focus for Alphabet, with analysts anticipating Google Cloud to grow around 27% in the quarter. And finally, Tesla announced results for the second quarter on Wednesday. Analysts expecting Elon Musk company to meet estimates for Q2. That's driven by stronger sales of the updated Model Y, but the recent rollback of EV tax credits under President Trump's Big Beautiful Bill could pose challenges for Tesla going forward. Well, that is a wrap on today's Ask for a Trend. Be sure to come back Monday at 4:30 p.m. Eastern for all of the latest market-moving stories affecting your wallet. Have a great night.